Looking for the best emerging markets ETFs to invest in? Well, you're in the right place. Emerging markets ETFs are exchange-traded funds that offer investors a gateway into the exciting world of developing countries like China, India, Brazil, and many more. These funds carry the potential for higher returns, but be mindful they also come with their own set of risks: volatility, currency fluctuations, political instability, and less developed financial markets. On the other hand, we have tech ETFs. These funds invest in stocks from the technology sector, encompassing everything from software and hardware to internet and cloud computing. While they offer exposure to the innovation and growth of the tech industry, they aren't without their challenges, such as competition, regulation, disruption, and cybersecurity. Both of these investment avenues have their own unique opportunities and challenges. So, are you ready to navigate these exciting waters? Let's dive into the top 10 emerging markets ETFs based on their performance in 2023. First on our list is the SPDR MSCI Emerging Markets Small Cap UCITS ETF. This exchange-traded fund steps into the vibrant world of small-cap companies in emerging markets. These markets, from China to Brazil and beyond, pulsate with innovation and potential. This ETF provides exposure to these dynamic companies that often exhibit higher growth potential compared to their large-cap counterparts. But this potential doesn't come without its share of risks. These small-cap companies are often more susceptible to market volatility, currency fluctuations, and political instability. Additionally, they may have lower liquidity and higher costs than larger companies. It's a bit like sailing uncharted waters. The promise of discovery is exciting, but the journey can be fraught with uncertainty. Investing in the SPDR MSCI Emerging Markets Small Cap UCITS ETF offers the potential for high returns. However, it's important to remember that the path to these returns is paved with the higher risks associated with investing in small-cap companies in emerging markets. Next up is the iShares MSCI Emerging Markets Small Cap UCITS ETF. This fund, much like the EMSM we discussed earlier, targets small-cap companies operating in emerging markets. However, it distinguishes itself with a slightly lower expense ratio. This means that the fund's total operating expenses are a bit less, which can translate into more profitability for investors. Moreover, the portfolio composition of the iShares MSCI Emerging Markets Small Cap UCITS ETF differs slightly from its EMSM counterpart. While both funds focus on small-cap companies in emerging markets, they each have a unique blend of holdings that reflect their individual investment strategies. But much like the EMSM, this fund offers exposure to the growth potential of small-cap companies in up-and-coming markets. Yet, as with any investment, it's important to bear in mind the associated risk factors. These include potential volatility, liquidity issues, and higher costs. Like EMSM, it offers exposure to small-cap companies in emerging markets with similar pros and cons. The third ETF on our list is the WisdomTree Emerging Markets Small Cap Dividend UCITS ETF. This unique fund specifically targets small-cap companies within emerging markets, a segment of the market that carries its own set of potential rewards and risks. What sets this ETF apart is its focus on companies that pay dividends. Dividends, for the uninitiated, are portions of a company's earnings that are returned to shareholders, providing a steady stream of income. This can bring a level of stability to your investment, particularly in the often turbulent waters of emerging markets. But as with any investment strategy, there are trade-offs. While dividends provide income and can offer some market protection, they may also limit the overall growth potential of your investment. Furthermore, the tax efficiency of the fund may be affected, as dividends are typically taxed at the individual's income tax rate. So, while the WisdomTree Emerging Markets Small Cap Dividend UCITS ETF offers a unique approach to investing in emerging markets, it's essential to consider these factors in your decision-making process. However, dividends may reduce the growth potential and tax efficiency of the fund. Next, we have the Xtrackers MSCI Emerging Markets ESG-screened UCITS ETF 1C. This ETF stands out for its unique approach to investing in emerging markets. It applies an environmental, social, and governance, or ESG, screening process. This approach is designed to exclude companies that may have negative impacts on society or the environment. Now, you might be wondering, what does that mean? Well, companies that engage in activities that harm the environment or have questionable labor practices or corruption issues are excluded from this ETF's portfolio. This screening process is part of a growing trend of responsible investing, where the aim is not just to generate returns, but to do so in a way that is aligned with ethical values. This approach can help reduce exposure to ESG risks. However, it's important to understand that this may also limit the investment opportunities and performance of the fund. So, as with any investment, it's crucial to do your homework and understand the potential trade-offs. Last but not least in our top 5 is the WisdomTree Emerging Markets Equity Income UCITS ETF. This fund is a standout for its focus on large-cap companies in emerging markets that pay high dividends. When you invest in this ETF, you're tapping into the financial powerhouses of developing economies, companies that have proven their stability over time. This strategy provides a dual benefit. Firstly, these large-cap stocks can offer a degree of stability that can be comforting in the often volatile landscape of emerging markets. Secondly, the high dividends these companies pay can provide a steady stream of income, supplementing any capital gains you might make from the stocks appreciating in value. This makes the WisdomTree Emerging Markets Equity Income UCITS ETF an attractive option for those seeking both stability and income from their investments in emerging markets. However, like DGSE, dividends may reduce the growth potential and tax efficiency of the fund. Now, let's shift gears and discuss why tech ETFs might be a better choice for some investors. The technology sector is a hotbed of innovation and dynamism. This constant evolution translates into a higher growth potential for tech ETFs. Technology companies are continually developing new products and services, pushing boundaries and creating trends. This constant reinvention often leads to increased demand and profitability, driving growth for investors. In contrast, emerging markets. ETFs, while they offer the potential for high returns, come with a higher risk profile. This includes factors such as volatility, currency fluctuations, political instability, and less developed financial markets. Another point in favor of tech ETFs is their lower volatility. The technology sector is largely insulated from macroeconomic factors such as interest rates, inflation, trade wars, and currency fluctuations. This insulation can result in less price volatility, providing a smoother investment journey. Emerging markets, on the other hand, can be significantly affected by these macroeconomic factors, leading to higher volatility. This could mean a bumpier ride for investors with greater uncertainty and potentially higher risk. Lastly, tech ETFs often boast higher quality. The technology sector is characterized by high barriers to entry, stronger competitive advantages, and more efficient operations. This often translates into a higher quality of investments within the ETF. Emerging markets, while offering potentially high returns, can lack these qualities. The barriers to entry in these markets can be low, competition fierce, and operations may not be as efficient. In conclusion, while emerging markets ETFs offer the potential for high returns, they come with higher risks. On the other hand, tech ETFs offer a balance of growth and stability, making them a potentially better choice for many investors.